Hey guys, how are you? Happy Friday. Carl, you ready
Hey,
for the weekend?
ready for the weekend, my friend?
Yeah, any big plans?
Probably some cycling. I've got some contractors at my house rebuilding my huge pool. So I'll be project managing some of that. And then, yeah, catching up with friends. Now, friends can meet up. So we've got this new rule in the UK, up to 6 people can meet. So my family and another family were getting together, the Millers, my very good
Yep, yep,
friends.
yep, yep.
We're all getting together and tomorrow night. So yeah,
Very,
it's
very
been a
good.
tough
Very,
week. So I'm gonna
very
get
good.
some
Are they
rest tonight.
gonna come over to your house? You're gonna go to their house?
I think we're going to their house.
Very good. Very good. Maybe do a little barbecue,
Yep,
little dinner.
yep. Looking forward to that. How
Yeah,
about
very
you?
cool. Yeah, not really sure. Just playing some catch up. Was on the road a few days this week, so probably do some catch up, hang out. I don't even know what the weather's going to be like, but get
It's
out, get some fresh
crazily
air.
hot in the UK. It's
Yeah,
gorgeous. It's like almost 80 degrees today. It's amazing. So I'm not complaining.
yeah, absolutely. So no, if the weather's decent, and I don't know that it will be yet, we'll get outside and kind of get rolling. Maybe get some exercise, go for a hike or do something.
Good man.
Yeah, not sure what. But as always, making deals. That's the plan. Name of the
That's the
game.
plan.
Today, guys, we got a really cool special Q&A for you. Obviously, first of all, shout out when you're here. We want to be able to say hi. But then beyond that, really cool. We're going to talk about money in the bank and whether you've got yours. And we're excited. It's going to be really cool. So we'll get to that here in a couple minutes. But beyond that, welcome. Looking forward to today's live. So shout out if you're here. Let us know. Let us know how your week's been, how your deal making's going, and keep on cranking. So
Yeah.
I know we were talking this morning about some deals, Carl. I'm pretty excited.
Me too. Yeah. There's just some lots of different funding opportunities coming around. I know I've not been in the US for 10 weeks, Adam, so you can talk about what you're seeing in the States, because I know you're running point on a lot of our deal flow stateside. But what's really interesting in the UK is in the UK, we've always had like a micro version of the SBA 7A loan, and it was called the EFG loan program, the Enterprise Finance Guarantee. So it's banks putting money into deals that is underpinned by the UK government. And that's all changed now. It's now called CBIL, CIBL, and it stands for Coronavirus Interruption.
I think you got it. It's CBIL.
Oh, is it
C-bills.
CBIL?
Yeah. Yep.
So it's Coronavirus Business Interruption Loans. So it's not technically there for people to use to acquire businesses, but what's allowed is for the business to generate that funding into the business just before you buy it. And then obviously that's a ton of cash that is then sat on the balance sheet and the seller can take out as part of the deal structure at closing. And the requirements are 25%, as I understand it, of a company's annual revenues. So if you're doing £1 million a year of turnover, as we call it over here, that's £250,000. If you're doing 2 million, it's obviously 500. And what's really interesting is the first £250,000 of that funding has no personal guarantees whatsoever. You only have to personally guarantee the money above the 250. But as you know, in the UK, we have a very strong, very mature personal guarantee insurance market. So we were talking to our financing broker, I think a couple of days ago. Was it Wednesday? I can't remember. Wednesday.
Yep.
And he's doing tons and tons of deals using this methodology. So we had a prox management call this morning, and we've basically like gone back to all of our UK deals that we were maybe a couple of £100,000 short as a closing payment, now knowing that we can quickly get this funding if we still want to do those deals. So I'm really excited for next week to kind of dig into, we quickly pulled out, I think it was like 12 deals that are really good deals that we want to own. We were just a little bit shy on the closing payment. So I'm looking forward to going back round those deals and seeing if we can close some of them with all this extra funding. So what are you seeing that's similar, Adam, on your side of the pond?
Yeah, well, before we jump to the US, just a quick couple of further notes on that, right? Is as Carl said, 25 up to 25% of the revenue. And as as a business grows and we think about, valuations for an example. So again, if you've got $1 million revenue business, you can get a loan for 250K. Well, if that business has margins of say 200,000 a year, right? So it's got a 20% margin on that million. Well, your loan service is debt service is what we always care about, right? What will you have available after you've paid your debts, et cetera, to take cash? That's why we do this, right? So in the case of the C-bills, it's generally a 5-year up to 6-year, but generally a 5-year repayment period. You pay, I believe, interest only or no payments for the first 12 months. And then it's a 4-year kind of amortizing loan after that. There's some splits in there, a portions traditional amortized and others interest only with a balloon. But by and large, if you're looking at the payments and you just assume a straight 5-year repayment, you'd pay, probably 60 or so thousand a year because of the interest expense, et cetera. So in a business that's doing $1 million of revenue, you pull in that extra $250,000, your debt service might only be 60K. So you should have somewhere in the 140,000 a year of potential free cash flow, depending if you've got capital expenditures or otherwise. But what's really exciting here is let's go and do some simple math. Say the business already has some surplus cash in it, right? So you're able to use that for a closing payment in the UK. But the bonus is that same business that's doing 200,000 on the bottom line, if we have a 2.5 multiple on it, right? That's $500,000 valuation or pound valuation. You're effectively able to fund a 50% closing payment without a personal guarantee on a business just like this. And that's pretty exciting. Of course, there's so many other variables that go into each deal, whether or not it might fit the model. But very simplistically, you can go to a seller and say, listen, I'll give you half up front plus your surplus cash. And by the way, I'll pay you the other 250K over a period of years or something like that. And because they're benefiting from the surplus cash at the point of transaction, that can generally depress the multiple of the business because ultimately they're seeing a big windfall as a result of that being a part of the deal. So I just see a lot of opportunities in the UK. So for anyone out there who's looking at deals right now in the UK, a lot of our UK friends or nearby UK friends, ramp up that origination, guys. I think there's a plenty of opportunity here, and get cranking on those deals. I think your ability to close has just really ramped up. So back to the U.S., Carl, what you were asking. So I'm starting to see lenders beginning to re-engage and open up, not in traditional loans, predominantly, people starting to explore what an SBA loan might look like. Again, those are loans of last resort typically for us. But the biggest thing is, will you be ready when they open? Will you have your relationship with sellers in place when they open? Are you going to be at the point of making an offer when banks are ready to go? If the answer is no, you're not, then you better get cranking, right? Because what's really important is you don't want to be late to the party, right? For those who didn't get PPP in the first go round, they thought they missed out. They didn't move quickly enough. They didn't apply quickly enough. And some of that was on the banks, let's be clear. Some banks just didn't do right by their customers and didn't open up their portals, et cetera, before the money ran out. But what's important for all of you guys is understand the game of deal making is one where you can be building the relationship and building that engagement and building the understanding of what an acquisition looks like with sellers right now, so that when financing's in place, even SBA financing, right, you're ready to rock and roll. And for those who are For those who are looking to do traditional LBOs, no problem at all. You should be working on those. That hasn't dried up. And so it's just important you guys really stressing from Carl and I today, whether in the UK, the US, or you're attracted to those markets as a point of business acquisition, be hunting those deals. Hunt. I've seen on the Facebook group the last couple of weeks, people scraping data from Biz Buy Sell and things like that. That's cool. That's great. But none of that's building a relationship, and none of that's good data in and of itself. You can't really rely on it, and you and everybody else is looking at the same listing. So if you want to really be a differentiator as a deal maker and really change your path forward, start hunting those off-market deals. Start really building your network and reaching out. I know Carl and I last week, we did a great challenge for people. We had, I think Faith's already here, but we had people who did 20 plus contacts in a week, in 4 days or so, right? Think about that. It's 8 a day, 5 a day, 6 a day, somewhere in there. I can't even math right now, but the idea is, right, like those are real efforts, real conversations that are happening. And are you doing that? Are you going to get that money? And that's what we're really focused on today. To kick things off is are you going to get yours? Are you going to get your money? And as it starts to open up and free up, you've got to be ready to pounce.
Yeah, well, that just reminded me. What does our friend Grant Cardone say? Who got my money?
Yeah.
I was just thinking about that as you were talking. So there's funding available, guys. Go find those deals. Check in with those sellers. Deals that you made offers on previously that were not accepted for whatever reason. Maybe you were shy of enough of a closing payment. Reenact those seller relationships. Find out how they are. What are they doing? How have they gone through COVID? Have their businesses struggled? Have they instead pivoted and thrived? Where are they right now? We're going to be getting back to normal very, very quickly. Sellers, financiers, your job as a deal maker is be the quarterback of the deal and pull all these different things together. And, we say this every week, but it's so important. You've got to take the action. Whilst, I'm sure you'll find these YouTube lives really useful. And if you're in the program and you're watching all the videos and you're interacting on Facebook, that's all great. But knowledge trumps execution trumps knowledge every single time. You've got to take the action to get the results that you want. Really important.
Yeah, absolutely. All right, guys, shouting out to those who are here today. We've got Robert, Jay, Faith, John, Mark, Jacques, EES. Glad you guys are here. Really looking forward to answering any questions you have. So if I haven't shouted you out, drop a comment in the chat. Tell us you're here. Hope you guys had a great week. Tell us what you're planning on doing on your deal making weekend. Craig's here. Hey, Craig from the UK. So let's see here. We got a couple questions, Carl, if we just want to jump right in. You ready?
Yeah.
Perfect. So Jay has asked, do you know any banks that accept sellers' equity in the UK?
Elaborate on your question, Jay. What do you mean by banks accepting sellers' equity? Are you talking about a seller retaining equity in the deal? Are you talking about more seller financing? If it's the latter, then absolutely yes. Banks love it when a seller will carry part, or however big a part that is, of the purchase price into the deal, because it's less money that they actually have to put in. And obviously what they'll do is they'll look at the cash burn of the business to service not only the bank debt, but also what the seller needs as well for those monthly, quarterly, or annual payments. So I think that's what you were referring to. But if it's about seller's equity,
he's saying seller's financing. Banks, if you're doing a full seller financing deal, you'll never talk to a bank. So no issues there.
The seller is the bank.
Yeah, the seller is the bank. When you say, he's added some here, the banks I've spoken to want fresh equity. Okay, so we're just trying to put together your question here. So we're saying you've got a deal, say you're buying a company for 100 grand, sellers effectively financing 20 grand, banks financing 80 grand, banks going, we want you to have skin in the game because you have nothing there. That's not an unusual ask in that situation.
Depends on the type of debt, though. So if the bank's putting the debt in as an unsecured lend based on the cash flows of the business, then yeah, they always want you to have some skin in the game. And if you don't have any skin in the game, then you just go and partner with somebody that has that little piece of capital, and then you would give that partner a piece of the business. Let's say that's 30%. So it's better for you to own 70% of something rather than 100% of nothing. If you're doing asset-based lending, so if you're using real estate, plant and equipment, you're using the accounts receivables, the invoices that have been issued but not paid. In my experience, you don't need to put skin into those types of funding, but wherever you need a cash flow loan, you do. Or go use the CBILS, the CBILS program.
Yeah, so that was exactly what I was going to say is in that particular case, I don't know how big the acquisition is, but if you can get up to £250,000 without a personal guarantee, depending on the size of the business, that might be just exactly what you need. The business takes the debt out, you hand the cash over, keep enough for working capital, and you got yourself a business. So great. Let's see here. Robert has asked, Robert's just telling us he's making serious strides with meeting with the right financiers this week and is about to make his first offer. Super motivated. You just have to keep taking action. You're crushing it, Robert. Nothing feels so good as getting those offers out, provided you've got all your ducks in a row. So very exciting. Let's see here. EE's asking us if you can have a 10-minute call, Carl, to talk about a particular acquisition. We don't necessarily do individual calls like that, EE. So sorry about that for a specific deal. The only specific deals we work on with people are those who are partners with us in Prox Capital Group, our private equity. Our partner program there.
If he was in the Academy program, he could submit that deal for a red light, green light. So Correct. We would review that deal anonymously on a call with 50 of the deal makers. So that's something that we could do. Yeah,
absolutely. So John said, spoke to a prospect who's retiring. He wants to know how it would run the Derbyshire business from Kent. Says his teams need close monitoring and hands-on management. How do you answer this? Well, John, this goes back to the classic general manager of the business, right? Sounds like the business doesn't have a GM. So if I were to be moving in and setting expectations there, I would very much be discussing with the seller, does he really have a number two? Doesn't seem like it if his team needs close monitoring. And that's hard to assess from the outside. Does it need close monitoring because the owner's micromanaging his own team, or are they really skilled at what they do, right? So, that's hard to understand from a distance. I would ask a lot more questions around what the owner himself is actually doing on a day-to-day basis and see if I could ascertain that. However, you got to get them comfortable at the end of the day, and you're not going to convince him otherwise if he firmly believes something about his team. He's going to know them better than you. So kind of phase two answer on that would be you simply explain your primary objective is to acquire the business and work with him to install a general manager who can keep that close set of eyes on the employees, talk through what that transition process and hiring process looks like. And a lot of that can tie back to the legacy style conversation where, hey, you're really working hard to protect your assets and what you've built. And would love for your help and input on really finding the right person to help manage this moving forward.
Yeah, and like that kind of client, it's a great comment. Normally when I see something like that from a seller, that raises a red flag for me because in a lot of cases that tells me that the seller is the business. And without the seller in the business, it's not going to work. So really, does the seller have a business or does he have a job? in his business. And to Adam's point, you just need a GM. If you don't want to move from Kent to it's Derbyshire. That's how you pronounce it, Derbyshire in my UK accent.
Yeah,
so if you don't want to move from Kent to Derbyshire, which is, I don't know, 150 miles probably, which you probably don't, then yeah, you just need somebody that you can parachute in to run it for you. If there's no one in the business, go find somebody, use LinkedIn, go and find a partner. They can even help you do the deal. And then as a GM, if you want to, you can give them a piece of the equity or even a profit share. So, partners are always great things to have in deals. I won't bore you with a story, but I'm fascinated by the SpaceX NASA partnership that's going on right now. It's going to be the first time NASA puts people into space for about 10 years, and they can't do it without each other. NASA's got the legacy, that institutional memory, all the experience of sending, I don't know, 400 or 500 people into space. But Elon Musk and SpaceX, they've got the technology, the savvy, the innovation, but they can't do it on their own. They don't have a launch pad. They don't have any astronauts. So they got to do it together. So that's a classic partnership that's a win-win. It looks like you need the same thing, for your deal in Derbyshire.
Yeah, absolutely. So let's see here. Shout out William, he's here as well. David's here as well. Glad to have you guys here. Jonathan's here as well. So glad to have you guys here. Looking forward to answering your questions. Okay, here. Let's see. Jonathan has asked, I've got a friend who owns a trucking company and wants my help. He's open to anything. He wants to get out of the business. He relies only on brokers, logistics brokers, has 20 trucks, Freightliners, and owns 2 diesel shops in Miami. So not really sure exactly what the question is outside of how you might help. But the biggest thing there is, have a conversation. Like, why is he really looking to get out? What is happening that is forcing him out or mentally forcing him out? That's always step one. Why are you selling? Right? Carl and I
might just be lonely.
Yeah, could be lonely. Yeah. Find out his why, because his why is ultimately going to drive every other element of his decision-making process. If he just wants someone to partner with, and you don't mind getting your hands dirty and helping, it could be a really great consulting for equity situation where you come in, he's just giving you a piece of the business because you're going to add value and support the ongoing growth. Other than that, I think it's really again ties back to the why. What is he really looking for? Why is he selling, or why does he want to get out? That's just where I think great logistics companies should be pretty solid companies these days. Again, I don't know what kind of freight he's doing, but yeah. So hopefully that helped.
My first deal was a transport deal.
Yeah. That's right.
I have some of that.
The accidental acquisition, right?
My accidental acquisition. For those of you who don't know the story, I was hired as a broker to sell that business, and instead I ended up buying it. And it was a great business. I've owned other transport companies as well since then. So I really like that space. It's a great sector to be in right now, especially in the UK, but I guess, anywhere. Like the whole spike in online sales, people have got to move the stuff from A to B. So great business to be in. But sounds like there's some options in that, Adam, depending on what the seller wants. So,
yeah, I mean, it definitely sounds like some options. I mean, I look at that and I go, consulting for sure. I think there's a way you can get a piece of that business with likely no money. Sounds very motivated. If you've already got a personal relationship, you've got that baseline rapport already down pat. But again, so much of that's going to be dictated by why they're actually selling and what they're looking for. But the real key there is it seems like you've got an option for a really good start to a conversation, which for me as a deal maker, I know just jazzes me up and gets me pretty excited. I'm always hyper enthusiastic about someone saying, hey, I'm ready to hit the road and take the next steps. I'm all about how can we get in there and have a conversation and see what happens from there. So looking forward to hearing what happens there, Jonathan. And very exciting, right? It's great to have that. That's an off-market deal, which we were just talking about. the real value of those. So very cool. David's asked, is skin in the game usually about 10% of the loan amount? So it really depends on the type of loan and what the loan's for. An SBA loan, for example, it's 10% of the total deal value, not the loan amount. So for example, if I had a purchase price of $2 million and I was looking for a closing payment of $1 million, so I was going to get an SBA loan for ideally that $1 million, right? The reality is I'm going to have to put in 200 grand, 10% of the total deal value, not 100 grand or 10% of the $1 million I'm looking for my closing payment. So on deals where you're looking to use, say, an SBA loan, that's got to be something you've got to remember and consider when you're putting your deal structure together, right? You don't want to offer someone $5 million with a $1 million closing payment in an SBA loan, because the SBA is going to require you to put in $500,000 into that deal. That's a lot of cash. You might be better off going to the seller and say, well, listen, I'm not going to give you $5 million for that company. I'm going to give you 3 or 3.5, and I'm just going to get a loan for the whole kit and caboodle and pay them out outside of a seller standby note. In that particular case, your actual cash injection from you or someone you've partnered with drops from that $500,000 down to 300 or 350,000, obviously plus loan costs and closing fees and all that other stuff. But in reality, if you're going to go the SBA route, the way that rule works, it very much incentivizes you to really get as big of a loan as possible tied to the purchase price itself, somewhere in that 80-90% range of the actual deal value. So just keep that in mind. Other deals, skin in the game can mean 5%, 10% of the loan amount. It really depends on the bank who's lending and how risky it feels to them. Right, traditional commercial lending can be 20% of the deal value. So it can go up. It's just important to know every case is different, and the financier you're working with is going to have their own expectations. Yeah, the type of debt, right? If you're doing discounting on AR, there's no such thing as skin in the game. They're just going to take the most qualified invoices with the best credited customers and payment history and just front that cash for you. So it's really important to understand what that looks like moving forward. Okay, here. So let's see, a few other people out here. So Theodore, hi, how are you, bud? Daisy's here. So looking forward to getting to your questions. Theodore's asked, how do I get into the Dealmaker Academy? That's super exciting. I will grab a link for you and we'll drop it in chat here shortly if you're interested in exploring Dealmaker Academy. We'll see if we can get you in a slot on that.
Right.
Carl,
there's a really good question from Jax around how does when you've got, when you buy a business and you've got 2 types of debt in the business. So you've got like asset-based lending or cash flow lending or the SBA, whatever it is. And then you've got seller financing as well. He's asking which of the 2 are subordinate. So in all cases, when you're doing a deal, the bank financing is the senior debt. So that's the financing that has the lien or the charge, or sometimes called the debenture, against the assets of the business. So the seller's loan has got to be subordinate to that. So technically, the seller's not going to take a second charge over the assets, because if anything was to go wrong with the business and the deal, the bank's just going to liquidate the assets to get their money back. There'll be nothing left for the seller. So what you do with the seller is you give them instead a clawback on the equity. So when you're buying a business, you're obviously, in most cases, especially if it's your first deal, you're buying the shares in the business, the equity in the business. So that's something that you can offer to give back to the seller if for whatever reason you don't make those seller financing payments.
Yeah, absolutely. And Theodore and anyone else who's interested, we've dropped a link for Academy into the chat. So feel free to check that out if you're interested in joining. And Jonathan, he's a member of the Academy. And, Jonathan, thanks for being a member. He says he's in the Academy and highly recommends it to everyone here. to join. So thanks for that great testimonial for sure. Let's see here. So Jonathan's provided some more detail about the trucks. He originally bought the trucks because of Amazon, then they canceled the deal, and then says the brokers take most of the profit. Industry's dying. Yeah, there's a lot of complicated stuff there. Would need a lot more information and practicality to understand the real opportunity there or not. But ask the question.
The success of a trucking business, because I've owned some of them, is just keep it really, really simple. Having brokers in there, for me, it's a bad idea. You can go direct to customers, and at the end of the day, a trucking business is just moving stuff from one place to another, and depending on what type of stuff it is, and depending on how far it's got to go, and depending on how quickly the customer needs it moving, those are the three things that typically affect how much you're going to charge. And I don't think it's a dying industry. That industry has absolutely boomed over the past 3 months. And I think what you're going to see when we come out of COVID, and we're starting to come out of it now, what you're going to see is a lot of consumers and a lot of businesses have changed their behaviors permanently. So a lot of people will continue buying online. A lot of people will do the things in the future that they've been doing over the last 3 months. So I see the trucking industry as a thriving industry, for the next few years. So if you can get a piece of that business or buy that business and then just really simplify how it works, you should do well. I wish I still owned my trucking business.
Yeah, and I think beyond that, right, it's you got to ask the questions. If the worst thing that happens is you went through the process, you asked the right questions, and you learn all about the deal making journey through this, but you didn't end up buying the company, that's going to be okay. You've just soaked up an incredible amount of skills and knowledge and experience by going through the process and doing it the right way. And that's just stuff you can't change or replace. And so I'd encourage you to keep pursuing, if only from an experience perspective. Carl and I talk about quality shots on goal, right? What we mean by that is you've got to have a certain number of conversations and a certain number of opportunities explored in order to really close a deal. And the only way you do that is actually taking the action. So because you're even just having the conversation already, you're miles ahead of a lot of people. So keep on cranking. So Daisy's got a question here. What's the best way to approach businesses which are not for sale? So first and foremost, you just start building a relationship with whomever the owner is. It comes down to relationships at the end of the day. Who are they? What are their goals, hopes, dreams, desires for life, their kids, their grandkids, the future, et cetera, et cetera. You'll find a lot of people are receptive to learning about you and you learning about them. Carl brings up a nice little book reference around you should be listening 3 times more than you're talking in those conversations, and that's important. You should, never split the difference. You should be able to, you might not have seen Carl's screen, but he was waving around the book. But it's important to know, that conversations are just that. They're a relationship building exercise, and you've just got to start there. And you can be somewhat direct about your intentions so they don't see you as being someone who's misleading. You can listen. I'm a budding entrepreneur. I'm looking to move into the acquisition space. I would just really love to learn about you, your business, your company. You're never going to be hurt by having those conversations and learning how to do them effectively. It's really as simple as just being a good listener and understanding who they are and how their business works and what they're looking for.
Yeah, and three tips for you, Daisy, to find those businesses. So the first thing that you can do is just go on Google, do some research, find a bunch of businesses that you like. You can get trials of free tools like Info USA or Hoover's, or depending on where you are, there's all these business databases. So you can build a list very quickly from one of those tools Let's say you want to buy a business between 1 and 3 million turnover or revenues in a particular location, in a particular sector. Type that in, you get a list, and then you can write to those people in a relationship building way. It's called the direct approach method that we teach inside of Dealmaker CEO. You can also leverage social media. You can leverage LinkedIn. You can leverage Facebook. There's groups out there based on industry. There's groups based on location. There's even groups based on buying and selling businesses. So join those groups and you can solicit deals from there as well. But the most important thing that you need to do is you need to build a network. So you need to talk to the people that a seller will be close to, or a potential seller will be close to, before they decide to push the button and sell the business. And we've talked about those before. So those are wealth managers, those are CPAs or accountants, those are lawyers or attorneys, and those are financiers or banks. So networking with those people in your local area is going to give you potentially access to deal flow, because a seller will talk to those people before they will actually decide to list their business with a broker. And only 20% of businesses that actually sell through a business broker. The other 80% are sold through these types of networks.
Yeah, very good. And again, everything can really be boiled back to relationships, networks, conversations with sellers and business owners, right? One of the things I like doing, it's almost like a practice, is a little different now. We're in, we've been dealing with COVID for the last few months, but say you go to a restaurant to pick up takeaway. If it's a small place, presumably the owner is there somewhere, just have a conversation with them. Ask them how things are going. How's the business working? Same goes if you go to take your car to the mechanic shop. Ask them how they're doing.
That's how we bought our restaurant, Adam, isn't it?
Yeah.
That's what you did.
Yeah. Inadvertently, right? I didn't go in there to buy or own any part of it. I simply went in there to eat some food, and they had a really awesome sign sitting below the counter where you order that said, "Pretend like it's 1995." Or we don't have Wi-Fi. Pretend it's 1995 and talk to someone. So I put my phone away and just talked to them, and ended up building a relationship that many months later ended up becoming an opportunity for us to own a part of that business. So again, think about every business you interact with on a regular basis. Is it the mechanic shop? Is it, a restaurant? Not that we really recommend restaurants as an acquisition, but you touch so many different businesses. You own a house and you call the window cleaner to come clean the outside of the house or the windows. Or, Carl, I know you've been doing a lot of work in your garden and have been having some support come in for that. There's nothing stopping Carl from talking to the business owners who are coming to help him at his house, right? Whether you're redoing your little pond area, the landscapers doing the yard and hedges and things like that. Talk to those people. Those are real business owners. Those are real opportunities to learn and grow and network. And at some point, every one of those businesses will look to transition from their current iteration to the next. And if you've got a relationship there, you're likely to be someone they call and talk to. So really, really important. Take advantage of all of those little opportunities that just come up in the ordinary course of life. Robert's got another question here. Forgive me if I'm misunderstanding. What's the typical point, in your opinion, in which I tell the seller that I'm leveraging the company's assets and receivables to buy the business?
So the simple answer to that is when you fall in love. So you don't do it right off the bat. So you don't walk into the very first meeting. And people have done this, and it really frustrates me. They walk in before they've built any sort of relationship, before they've understood anything about the business or asked any of the questions. They say, yeah, so I'd like to buy your business, and I'm not going to put any of my own money into it, and I'm going to be leveraging your business to buy it. That's going to be a very, very short meeting. You're not going to get far by doing something like that. So the key time to do it is when two things simultaneously kind of happen. So the first is that you've signed a letter of intent to buy the business, or a term sheet, or sometimes called a heads of terms. in the UK, or a memorandum of understanding if you're down in Australia. I don't think we've got any Australians on the call. So once you've agreed the terms of the deal, then what you typically then need to do is supply a proof of funding letter. So that will be the term sheet that you've got from the bank or whatever financier you're partnering with. So that's really the time that you do it, but only when you've built a very, very solid relationship with that seller. They know you, they like you, they trust you, and they really want you to have the business. They see you as that safe, trusted pair of hands to take the business to the next level.
Yeah, absolutely. The fall in love comment is ideal and correct, right? Sell them on who you are, and have that relationship built in a place where, more than anything, they want you to be the person to buy the company. They want you to be the person to take over and lead it to the next stage of life.
It's like dating, isn't it? You wouldn't walk into a bar. So
yeah,
it's like dating.
It's the dating analogy.
You walk into a bar, you meet somebody for the first time. You're not going to ask them to marry you straight away. You're going to date them for a while. You're going to go on vacation with them. You're going to get them to know you, like you, trust you, fall in love with you. And then when you think, yeah, we've got a great future together, then you pop the question. And if you've done all the homework and you've done everything right and they feel the same, they're probably going to say yes. And it's the same when you're doing a deal.
So what Carl's really trying to say is from now on, you guys can call him the love master instead of a deal maker. He's all about building that love.
Building that love.
Building that love. Okay, so HK has asked to follow up, is the clawback to the seller worth anything if things go wrong and the bank has to liquidate? Won't the seller's lawyers tell the seller that? Generally speaking, if you've got a clawback, you don't have external financing in quite the way you're talking about, where you've gone to a bank and done a traditional kind of financing deal. In those cases, you might have levered up using some AR or like receivable financing, some other asset financing. But if you're doing a more traditional kind of financing, an SBA loan here in the US, or even C-bills or something like that, where it's big enough for there to be a personal guarantee, in that case, you're rarely going to have a situation where you're going to have clawbacks on the seller's note. You just don't see those two things in conjunction. Normally, clawbacks are associated with a fully 100% seller financed deal. Anything to add to that?
Yeah, I've had instances where it's not very often, but I've had some rare instances where there have been equity clawbacks where I've had financing. But what I've also done as well in times is I've offered to give the seller all of the business back if I wasn't able to make the seller financing payments. So I might have paid 25% of it down using the AR or something like that, and then the 75% that was left to pay to get the deal closed, I've had to offer all of the business back if I didn't make all the payments. So, but yeah, it is rare, but it does happen occasionally. And what's also interesting is if you're doing a deal with an equity partner, so let's say you're doing a deal where you've got some debt financing, some seller financing, and there's also an equity piece that comes in. The equity investors, they know that they're right at the bottom of the pile when it comes to any lien charges or debentures on the business. And that all then comes down to the negotiation. How much equity are you going to give based on the amount of cash that you're putting in? So let's say you're buying a business for $1 million, and let's say you're paying 500 down and 500 seller financing. Let's say you're getting 400,000 from a financier and you're 100K short and you don't have it, and you go and get an equity partner. You would think mathematically that you would be giving the investor 10% of the business because they're putting in $100,000 on $1 million deal, but it never really works like that. You'll have to negotiate. You might end up paying 25% or even 30% of dilution to get that partner in. They're not just going to put in the 10% for 100K. They might want 25 or 30%. But again, we said it before, it's better to own 70% of something rather than 100% of nothing.
Yeah, no, absolutely. And I think it's It's just important to realize that deal structure is ultimately what drives the vast majority of successful closes, and that deal structure matching what the seller is looking for and wants and desires for an exit. And the best way to ascertain that, kind of, we're on the love matchmaking relationship side of things, but that's where it all comes from, is your ability to build that strong relationship and really understand what the seller's looking for. Let's see here. Alex has a bit of an accounting type question. How do you know how much of it accounts payable are due to be paid each month when doing a cash flow forecast? Well, accounts payable and accounts receivable are pretty much the exact same thing, just two different sides of the coin. So I'll explain AR first, because AR is a little bit more straightforward. So accounts receivable, if you want to get a rough approximation of when you're going to collect that, you have to figure out what's called the AR turn. And what the AR turn is you're taking your total revenues and dividing it by your outstanding accounts receivable balance. And what that's telling you is how fast do you work through the accounts receivable. So if your accounts receivable balance is $1 million and the revenue of the business is 5 million, and all revenues are invoiceable revenues, meaning they're not consumer type revenues. In that particular case, you would expect accounts receivable to turn over 5 times throughout the course of the year. So 12 months divided by 5, we get into some weird fractions there, but the idea is that you should be collecting, 400-ish K per month, right? Maybe a little bit more. And so the idea there is, as you're kind of evaluating, that'll give you some rough approximation. However, there's always seasonality, comes in waves and flows, and you've got to be able to anticipate that. That's why we always recommend monthly financials for at least the last year or two, as you're doing those projections. Accounts payable is a little bit different, because with receivables, you're really generally looking at the full revenue amount. Payables are a little bit different. One, you do want the aging schedule. Just like receivables, we also match up to an aging schedule. That's anticipating how old are the invoices when people typically pay them to you. With a payable schedule, you're going to have similar terms on the invoices you have to pay, and you've got to see what that schedule looks like. But if you're really future casting over the course of a year, that timing actually becomes irrelevant. And the reason is if your anticipated expenses in a given year, you've got non-payables and you've got payables. Non-payables are things like salaries and rents, although rent can sit in a separate payable sometimes, but really it's your wages and labor kind of costs. Beyond that, right, you've got all your payable expenses. If your total expenses over the course of a year are $2 million, effectively spread out, you're going to have to pay 180,000 roughly, 175,000 roughly, whatever that number is, approximately, to hit that mark. So the idea is you're just looking at the overall expenses and seeing that there might be some timing associated within it. Again, seasonality is really important, but you can typically look at those things from a pretty high level to see what your overall macro level cash flows are. Anything to add to that, Carl?
Yeah, so I do it kind of slightly different way. What I do with receivables and payables is I calculate them in terms of days. So with receivables, I'll divide the receivables number by the revenue, multiply it by 365, and then that tells you on average how long it's taking for a customer, to pay you. With payables, you don't do it with revenues, you do it with cost of sales. But the interesting thing about receivables is when you have an AR facility to finance a deal, what's also good about that is that gives you a massive cash flow boost post deal. So you take the facility to buy the business, and then going forward, as long as you carry on trading, and at worst the revenues are flat, but obviously you want them to grow, then let's say your average is 60 days. So that means that when you invoice a customer, on average, they're paying you 60 days later. When you have an AR facility, as soon as you supply a product or a service, you generate an invoice, you drop that invoice into your AR facility that you took out at closing, then you can draw down on the majority of that cash within 24 hours. So So you're still paying your payables every 60 days. You're still paying your rent and your rent every 30 days, your employees every 14 days in the US or 30 days in the UK, and everything else you're paying in the future. But now you're collecting your cash from your receivables in 24 hours. So it's just accelerating your cash conversion cycle and bringing more cash flow into your business.
Absolutely. Yeah. So let's see. HK has asked, the concept of surplus cash seems very nuanced. The 1 month revenue estimated seems quite broad. Can you please speak to how to convince the seller what is necessary to operate the business and what is not?
Yeah, and so there's two elements to that. One is cash, and cash is a part of the overall working capital. So your working capital in a business is your cash, your inventory, your receivables, less your payables. So every business needs working capital to allow it to trade. And what we do when we're making offers and we're using the simple model, the goal is we're looking to get shots on goal, make lots of offers on lots of different deals. Then we approximate at that stage, and this is based on the hundreds of deals that we've done, we approximate that you want a business to have at least a month's worth of revenue in cash. So if a business is doing $1.2 million per year in revenues, then ideally the day you take ownership of that business, you want $100,000 in cash. And the reason we specify cash particularly is other parts of your working capital aren't liquid. Cash is cash and you can do things with it. Receivables, they're liquid if you've got an AR facility, but inventory is not liquid. You might have a bunch of inventory in your business that might take a week, 2 weeks, 3 months to actually sell and turn into cash that you can use. So we always want that month's worth of cash. What we then do is, as part of the due diligence process, we fine tune what that number needs to be by doing a forward 12-month cash flow forecast. Because, and Adam mentioned it before, what you see in a lot of businesses is seasonality. And if you've got a business doing 1.2 million a year in revenues, then it's very rare that business is doing exactly $100,000 per month. If they're an ice cream manufacturer, their revenues are going to be a lot higher in the summer months and a lot lower in the winter months. If the business is a landscaping business, again, it's not going to make much money in the winter months. It's going to make most of its money in the summer months. If your business sells snowmobiles or chains for tires, you're going to be killing it in the winter, but not so much in the summer. So all businesses are seasonal. So what we do in that cash flow forecast is really kind of sensitize what's the minimum amount of cash we actually need to successfully trade the business through the year, and then we bake that into the deal at closing. But for making offers and getting a lot of offers out, we just take the 1/12 rule, and as I said, that's not just a guess. That's based on making thousands of offers and buying hundreds of businesses.
Easy enough. Hopefully that answered your question. HK is coming back with a question around procs. What percentage of deals do we do that don't require cash, or, the fully levered up or seller finance? And how does this apply to an asset-light SaaS or software company? So we should broaden that a little bit. How many deals out there, Carl? You've done hundreds. How many deals have been these fully financed deals? Versus not? And tied to that, how do you handle that? The real question here is, how do you handle an LBO with an asset-light business?
Yeah, so on the first part, I would say probably about 75% of the deals that I've done or I've seen have not required any equity investment at all. They've been either a business where I've just picked it up for $1 and taken over the liabilities. They've been 100% seller finance deals, or they've had earnouts, or they've been cases where closing payments have been justified from surplus cash, AR financing, and maybe top up cash flow lending as well, with personal guarantees and personal guarantee insurance that I've taken. I'd say the other 25%, some of them I've actually put my own money in. Others I've partnered with equity investors as well. So that's the kind of general mix off the top of my head of all the deals that not only I've done, but also that I've seen. And then go back to a SaaS business. So you're right, a SaaS business has no assets. So they probably lease all their stuff. They lease their building, their computers, all those different things. They don't typically have invoices because SaaS businesses, software as a service, if you don't know what SaaS is, your customers are paying per user per month, either generally via a credit card or PayPal. So the business has got great cash flow and great profits, but no assets. So the only way to do a deal like that is through a cash flow financing, and that could be a traditional type of loan, or it could be something down the SBA. And for those situations, as you know, you have to put in some equity. And if you don't have any equity, then you have to partner with somebody that does. And as we've said, I think 3 times already on this call, it's better to own a piece of something than 100% of nothing. And don't underestimate the power of partners in all aspects. A partner to buy the business with, an investing partner so you can close the deal, partnering with advisors to get the deals transacted, for you. So that's how I would do it.
Very good. Very good. Easy enough. Steve Rooms, hey, how are you, man? Geraldine's here as well. What are your views on brokers who work on behalf of the buyer? We talked about this, I can't remember, Carl, in the last few weeks. I have a fairly strong opinion on this. My opinion's formed just from my own experiences, so it's anecdotal at best. However, I am not a fan. The comparison is made to real estate brokers. There's a very big difference between, I think it was on an Academy call, actually, Carl. But the difference for business brokers versus, say, like real estate agents or something like that, where you very typically have a buyer's agent, a seller's agent, is real estate agents are regulated. They're licensed, and they have a lot of fiduciary and legal liability associated with representing you as a buyer in a manner that matches your needs and your expectations as a buyer. Even though their fee ultimately comes from the transaction, and in some cases, and in a lot of cases even, the sellers are responsible for those fees. For business buying, it's completely different. There's no regulation, there's no real liability, and I'm speaking predominantly here in the US, Carl. You can come behind me for the UK, but the thing is, there's no protection for you. And so at the end of the day, if they're splitting the fee with the seller's broker, to me, they've ultimately represented the seller. They only get paid if that deal gets done, and they're going to push to do a deal that's more favorable for the seller, because that's going to be more likely to close the deal. The second element of this, in terms of a buyer's agent, is, and I've seen this before, these buyer agents, all they'll do is they'll troll broker listings and then just put them in front of you. Well, that's not adding any value. You can do that yourself. You can sit on the web and do that. So why are you going to ultimately complicate the deal? Now you have 4 parties. You've got the seller, seller's broker, your broker, and yourself. 4 parties that all have to come to terms on something and be happy with it. And everyone's got an economic interest in some capacity. Not a big fan of that. That just makes things harder. And we're not even talking about the seller's attorneys and accountant and all those other people who will ultimately play a role in this as well. So for me, I'm not a buyer's agent kind of a guy. Does that mean I avoid building real relationships with brokers who represent sellers? Absolutely not. I'm happy to do that. But they don't represent me, and I very much have that understanding when they're sending me a listing and saying, hey, would you be interested in this company? So buyer's agents, if you do work with them, I think you've got to be hyper cognizant that the only deal you're going to be willing to pay them for is going to come from an off-market opportunity. It cannot have another broker involved. And you've got to realize that if you're expecting the seller to pay for that person, you're adding a big complexity to the start of that relationship with the seller. You should only ever pay that broker upon success, and you should use the cash flows from the business you buy to pay them. And that has to be part of that deal. And you've got to set it up in that way. So for me, I generally stay away from them. If I were to use it, it would be in that very specific case where it has to be off market and they've got to be comfortable with a fee arrangement that is supported by the underlying business I would close on. Other than that, they're an
that's the
impediment.
key. Yeah, so that's the key. And in the UK, like there is some regulation with business brokers in the US. I think Texas, New York, those are some of the states where it's a regulated practice. The UK, there's no regulation at all. But Adam's right. You can't use one broker to sit on both sides of the deal. It's a massive conflict of interest, whether it's regulated or not. You know, who are they acting for? The only time I've ever used a broker for deal origination is, as Adam said, purely for off-market deals. And what you tend to find with brokers is they'll go and pitch their services to businesses, and the business owner doesn't want to work with the broker because there's a high upfront fee. So the broker knows the business is there. It's still an off-market deal because it's not been put up for sale yet. And they offer to connect me to that seller, but that's all they do. They're not adding any value. They're not doing any work. They're just basically connecting A to B and then backing away. And then I'll pay them a very, very small contingent fee, you know, if that deal closes. I've made it work a few times, and there are some brokers in the UK that I think Chelsea Corporate is the big one. They only work for the buy side. So, you know, they don't sell businesses. They only buy businesses on behalf of other businesses. So they're only ever sat on one side of the deal. And it's a really important thing in all deals, in that advisors, brokers, whoever you're working with, you've either got to be with the seller or you've got to be with the buyer. You can't straddle a deal and advise both sides. It just doesn't work, because buyer and seller have got two completely different objectives. The buyer wants to pay the least amount of money in the most favorable structure, and the seller typically wants the most money and he wants it all now, or she wants it all now. So you can't have somebody trying to straddle that divide.
No, absolutely. And it's one more big impediment, in my opinion, in that particular case. So
cool.
Just before we wrap up with the last question here from Geraldine, if you guys haven't started your journey, check out Carl Allen's Business Buying Blueprint. We'll drop the link in there for you. And also, and this is really, really important, please like and share the video. We love it when you guys expand our network of deal makers. We love to have you guys as a part of that journey. So like the video, share the video. We really appreciate it. Share it to your friends on Facebook. You know, we want to help as many people in the world as possible become business owners and entrepreneurs. That's our goal. And it's really, really important to us that we have the opportunity to do that. And so we appreciate all the support that you guys can give us, again, by liking the video and sharing it. Okay, so Geraldine's question, Carl, last one here. Hi, everyone. Spoke to an asset-based lender this week, and he said all asset-based lenders only do comfort letters for conglomerates. Is this just his network of lenders? He's in a franchise group called Liquid Capital, or is it just a matter of building rapport? So I'll let you take a first crack at this, Carl.
Yeah, so that's not my experience, Geraldine. If you build relationships with financiers, they will give you a comfort letter. But let's just quickly clarify what a comfort letter is. So a comfort letter is not a term sheet. Yep. You know, a term sheet is proof of funding. A comfort letter or a comfort email is you speak to a financier to build a relationship. They get to know you, like you, trust you, and they say, hey, Geraldine, thanks for the meeting or thanks for the call. Good luck on finding a suitable business. Once you do, bring it to us. We'll be happy to look at it and potentially be your financing partner. So that's an example of like a comfort letter or a comfort email, which they tend to be these days. And then you use that when you talk to, say, a broker who says, well, you know, how are you going to fund the transaction? And we say, well, it's a mix of equity, debt, and seller financing. And they say, well, who are you using? And I say, okay, here's an email from my financing partner. And it's just making them comfortable that you've got credibility, you've got partners in your pocket that you can plug into the right deals.
Yeah, absolutely. So pretty much said what I was going to say is that it comes down to relationships. You do have some limitations. You're saying he's part of a franchise group in this space. So you're probably going to have a little bit of limitations that whoever this individual is doesn't fully control. Again, it's the challenge of working with a franchise. They don't necessarily drive the rules. The mothership does. So there could be some limitations there, but build a relationship and network. All right, guys, thanks so much. Hopefully we got everything for you. Looking forward to seeing you guys next week. Again, like and share the video if you can. We really, really appreciate it and are looking forward to continuing to serve you. We'll see you Monday, 11 a.m. Eastern, Facebook Live, Mindset Monday. So we'll see you there. Until then, have a wonderful weekend. And remember, you're just one deal away from changing your life.
Thanks, Adam. Thanks, everybody. Have a great weekend wherever you are. And we'll see you Monday. Until then, bye for now.
Bye, guys.